right, everyone. Good evening. Let's get started here. Thank you so much for taking the time out of your busy evenings to come learn about Marshall Reddick Mortgage Fund, and we're going to go over our Q1 results. Nice to meet you, everyone. My name is Tyler. A little bit about me. I was born and raised in New York. I went to Clarkson for financial analytics and portfolio management, and I'm an investment advisor here at Marshall Reddick. So my job is to intimately understand all of Marshall Reddick's products and services and be able to speak to our investors on how those products and services would work for their portfolio. You know, when we're comparing to retirement accounts, CDs, stocks, positions, you know, hard real estate assets, things of that nature. It's my job to be able to fully understand your position and then be able to advise on our products and services that could help you accomplish your goals. Right, so this is our agenda for this evening. I'm not going to read every line here, but at a high level, we're really going to dive into the fund this evening. We want to make sure that by the end of this seminar, you have a really good grasp and understanding of what the Marshall Reddick Mortgage Fund is and how it's been performing. And we're going to dive into our most recent quarter and really go over some deep dives on some numbers for you. The Waterfall section is a great section to really pay attention to. We're really going to dive in to how that works and how it goes into our profit and loss statement and things of that nature. So that's a great one to pay attention to. I also just want to let everybody know that there is a question box here on the seminar this evening. If anyone has any questions, please feel free to answer those, and we're going to dive into those at the end of the seminar this evening.
Thanks, Tyler. Happy to have you on the call this evening. Thanks to everybody who's joining. My name's Patrick Prunty. Always a pleasure to be with you. One thing I wanted to share is that all of the fund consultants that we have here at Marshall Reddick, they are also investors in this mortgage fund. And as we kind of dive through some of the metrics tonight, one of the things I'm most proud about is the fact that we as a staff hold roughly 10% of the total capital on hand with Marshall Reddick Mortgage Fund. And that just really goes to show how much we eat, breathe, sleep, and live this. And it's wonderful to come to work every day and do something that you truly love. And I can certainly say that for myself as a 20-year Marshall Reddick employee. It'll actually be 21 come June. Can't believe how fast time flies. Again, my pleasure to be with you. Most of you on the call know me. We've probably spoken before. We certainly have a number of new folks on the call who are interested in investing with us. Welcome to you. Again, my name is Patrick. I am our principal fund manager. A lot of things go into that, but for example, you know, I'm the primary chooser of the loans coming through our private lending pipeline, and which of those are going to be selected and funded by the mortgage fund, depending on, of course, you know, our capital and liquidity at that time. I have a number of other roles here at Marshall Reddick, and I'm out of the Newport office, so I'm here to be of service to you, and I look forward to working with you if we're not already working together.
Thanks, Pat. And that's a great point to bring up on the employee investment. I know a lot of people on the call tonight, we've already spoken about this, but you know, me personally, I have 11% of my net equity in the fund. I reinvest my earnings every quarter, and it's been an absolutely awesome tool for my portfolio. You know, I'm heavily involved in retirement planning, and I have a large stock portfolio position and some other private equity positions as well. But the fund has been absolutely awesome, and you know, I'm really excited to be able to present this option to you guys on the call tonight. We're going to switch things up a little bit compared to how we normally do this. So before the seminar this evening, I called most everybody here, and I got a lot of you on the phone, and we had some great conversations. And I had noticed a number of questions that I was getting from everybody. And so I thought it would be a great starting point to go over some of those frequent questions I was getting from our calls over this past week so that we can really set the tone for this evening. Pat, I'm going to ask you to answer these for me if you can. I appreciate you. So this was, you know, obviously the first question I was getting from our newer investors, and that, what is the mortgage fund?
Yeah, well, I field questions like this all the time, and certainly always happy to do so. And this is a great one, right? It's, a lot of people are kind of confused on what this fund actually does. And the bottom line is that it's a private debt fund, debt being the key word there, right? We take capital from accredited investors and we lend it out. We lend it out to real estate professionals, and we have some very strict metrics and guidelines that we follow. So for example, first lien position only. As a conservative investor, that's got to be number one when it comes to lending. Residential real estate, that's what we do here at Marshall Reddick. We're not in the commercial space. We really love single family homes. I think that comes out huge when you take a look at our portfolio holdings for this mortgage fund. And then of course, we're equity lenders. So we're lending at favorable loan to values and strictly non-owner occupied. Right? There's no owner occupants borrowing money from us. Those folks need to be borrowing conventionally with Fannie Mae products that are better suited for their needs. Our folks instead, again, are real estate professionals, and we'll kind of go over a little bit more about that borrower profile as we move through this presentation.
Thanks, Pat.
As far as the accredited investors go, they receive a quarterly earnings distribution. That's important note there. It's quarterly. The distributions are based on a preferred rate as well as a profit share, right? So there's two elements of the return that is paid quarterly. And ultimately, our target net to investor, so after expenses, is 8% per annum.
Awesome, thank you. And could you dive into a little bit more on what is an accredited investor?
Totally. I get this question a bunch, and they're like, I've never had any investment, like ask me if I'm an accredited investor before. But I think it's important to establish that this is not a Marshall Reddick term. This is like an SEC term, and it's actually nothing new. It stems all the way back from the Great Depression. It's a little outdated. They're talking about changing some of the rules revolving around accredited investors. But due to our structure, right, we are registered with the SEC. It's an annual registration that we have to do so that they're aware of our private fund. But because of our structure, we're actually only able to take investments from accredited investors. And we could go down a long road of the actual definition, because anything that's defined by the government, of course, is very lengthy and overcomplicated. But here, what we really need to understand is that they're looking for to ensure that we're taking capital from folks that are either reasonably high income earners or that have a reasonably high net worth. So if you want to invest with us, we're going to need you to demonstrate that on an annual basis, you're earning north of 200,000. And if that's not an option, but you have net worth outside of your primary residence, and you can distribute that you've got a net worth greater than 1 million, then you qualify. And the bottom line here is that this is not a big deal. This is actually a simple, easy process, and there are a number of ways that you can get accredited, but we'll talk about that specifically with you one-on-one when you schedule a consultation with somebody like Tyler, one of our fund consultants, or with me directly.
Awesome, thanks, Pat. I get this one a lot. Who borrows capital from us?
Indeed, and there's a number of folks that do. A lot of capital that we're lending out is to flippers, and we all see that in our day-to-day just driving around, and it's like those signs, and I see it more and more like at the gym. I'm seeing those commercials that are in between like the news shows or ESPN that are, we buy houses for cash type groups. Like those folks actually aren't paying cash. They're using a private relationship, a private capital provider like Marshall Reddick. In addition to flippers, we also lend to home builders, and we're not talking, about Lennar or DR Horton here. Like those folks are bankable, but there's a lot of infill new construction, a lot of smaller spec home builders or custom home builders that are building for other people. We also have a lot of our own clients getting creative today and trying to build in a little of their own equity position. So they actually buy the land, then hire the builder, and then come to us to borrow the capital to have that builder build the home. Then they refinance to hold that asset as a rental property long term, and we function just sort of as that capital provider that they might otherwise not be able to get. A couple others to round out who are the capital borrowers from us. Self-directed retirement accounts, this is a big one. You need a non-recourse loan in order to borrow money inside of a self-directed retirement account. And there's a lot of folks trying to tap into their nest egg and own non-traditional assets, such as real estate. And those folks can come to us. This is another one of those niche sections that we fill, that no matter how good your FICO score is, no matter how much capital, no matter how low the LTV, this is just not a loan that a federally regulated bank selling to Fannie Mae can fund. They just simply can't sell it to Fannie Mae. It doesn't meet those guidelines. And that's just one of those, reasons Fannie Mae just doesn't necessarily have common sense guidelines like we do in our private lending department. Rounding that out, Marshall Reddick clients with unique situations. There are always those unique situations, and a lot of folks, sometimes it could be self-employed, right? And as a self-employed individual, you write off a lot of your income, and then you may not be able to fit that conventional box, and therefore, you might need to use a private credit provider. So these are the 4 general buckets of folks who borrow from us, and I got to tell you, there's just no lack of demand for private capital, and we're going to talk a little bit about those unique nuances as we progress forward.
Awesome, thanks. This was a very common one, and it's actually, something that I went through myself too, as banks have started offering 5% CDs. Can you tell us how this 5% CD compares to the funds?
Yeah, I've done just about every kind of investment over the 20 years I've spent with Marshall Reddick. Certainly everything real estate related, things non-real estate related, and both good and bad, mostly good, of course, because I've just been exposed to a lot of positivity, but it's good to try new things. And what I've learned about that is that I take safety over yield any day, but not, I don't need too safe, right? I don't want to gamble the hard-earned principal that I've worked so hard to save, right? I've got to preserve that, but I do need to find kind of that middle ground, that correlation between risk and yield. So for me, when it comes to the comparison to the bank CD, Marshall Reddick Mortgage Fund stacks up pretty close, right? I don't think a lot of people quite understand that. So I've got a comparison between the two, and what it boils down to is your bank CD and the folks that, certainly 5% is a heck of a return. I don't think we're going to see that forever, but we have for the last year or 18 months or so, since interest rates have started to rise, because banks need to protect those deposits, and they can certainly lend out at higher than the 4 or 5% that they're paying you. When it comes to the top 3 categories, though, it's safety, liquidity, and yield. Those are like the mashup of the formula that you need to make as an investor to decide, what is your correlation of risk versus return. And so here, of course, we've got safety very high, we've got liquidity very high, yield fairly low in the grand scheme of things, but not bad. Okay. One thing I wanted to point out here is the FDIC insurance, and I'm going to make a parallel to the safety with Marshall Reddick Mortgage Fund, because the bottom line here is that the fund, it ranks very high, if not right next to the safety offered by the FDIC insurance bank account. If you were to research the FDIC, you'd find that really on their books, right, they've got about 10 to 15% of the actual insurable deposits on bank balance sheets. So if we were to have some kind of catastrophic banking event, don't forget that, just about a year ago that Silicon Valley Bank and so on and all these different jitters, and certainly some people did get bailed out, right? But again, in a catastrophic banking event, which I hope we don't see, the FDIC doesn't have enough insurance to cover all of those deposits. And in this day and age, I'm not sure I trust the government as much as I trust the hard asset nature of real estate that's tangible, okay? So making that comparison again, our loan to value, our roll-up loan to value in our portfolio is under 65%. And our debt is senior or primary to borrower equity. So if we're lending at good loan to values, which of course 65% LTV is fantastic in terms of safety. It's the borrower's equity, their down payment, that is at risk, right? And I think that that ranks really high, and if not right next to the safety when it comes to comparison to the bank CD. Now, that said, on a liquidity standpoint, we're very similar. Of course, there are some CDs that are, 3 months, 6 months, whatever, but a lot of them are 12. I've seen even longer than 12. We have a 12-month minimum lockup. That is it. After that, you don't sign up for another 12 months. It's just like a month-to-month lease thereafter, right? So we've got high liquidity with the fund as well, and we just pay about double what the bank CD does today. So, I'm not sure if you're ultra low risk, then you might consider the bank CD as the right move for you. But for someone like me, right, I would absolutely take the mortgage fund over the bank CD because it ranks high with safety and liquidity, but pays double on the yield.
Awesome, thank you. This one too, right? A number of us spoke about this when we had our conversations before the seminar. You guys are analyzing alternative investments, and a lot of us have come across these apartment syndications with these, relatively high returns and things of that nature. Pat, if you wouldn't mind diving in and just talking about, what this scenario looks like and how it compares with our offerings.
Absolutely. This will point back to what I discussed on the prior slide there, just briefly, is safety over yield, but only to a certain extent. An apartment syndication can be a very high yielding, very fantastic investment. And it doesn't just have to be an apartment. There's all types of real estate syndications, right? And in that situation, what's happening is you've got a promoter, you've got an operator that is going out and they're acquiring an asset with the intent oftentimes to improve it, right? More properly manage it, and then dispose of it in a crystallization event at some point down the future, right? And so there are some real negatives there, at least when you compare it to Marshall Reddick Mortgage Fund or your bank CD. And let's kind of dive in the same kind of methodology in a side-by-side comparison. So when it comes to safety, I would argue that this is ultra low, right? It is unsafe. And the reason is that it is junior to institutional debt. That operator out there that's buying that apartment building, they are usually 65% of that purchase price is coming from some kind of bank who's taking the primary position. And you, as the equity partners, well, you guys are crowdfunding the rest of the down payment and the renovation or improvement or fix-up money. So in the event that deal goes sideways, you could potentially lose 100% of your investment. And that's where I'll speak to the fact that I'm just not willing to gamble to chase high yield. Certainly 15 to 20% is very handsome. I'm just not sure that that's high enough for me to potentially lose all of my money, which is just flat out impossible with Marshall Reddick Mortgage Fund, who's lending in primary position at favorable loan to values. To further kind of tamp down the pros and cons between the syndication and the fund, liquidity, again, very low. Oftentimes here, we're going to be looking at a 5-year or more lockup. So you're just not getting that capital back. You have to part with it for that period of time. And you're hoping that at the crystallization event, meaning the sale or the refinance of that asset, that the operator did what they said they were going to do, which is when you're going to realize that high 15 to 20% yield. Again, comparing that across the deck here, remember, we're that 65%, that short lockup period, and that 8 to 10%. So I feel like we fit that perfect mold of safety, liquidity, and yield. I hope that really helps from my perspective.
Thanks, Pat. Appreciate that. And I know our clients really appreciate that too. Those were all very common questions in our conversations this past week. So thank you for the time. I know they appreciate it. All right. So with that being said, let's dive in here. Pat, what is new with the Marshall Reddick Mortgage Fund?
Yep. A couple of things I really want to touch on tonight. Number one is that we have an opportunity. This is not just a fly-by-night opportunity. This is not something that's here and then is going to be gone, but we are actively raising capital. and we're doing so a little bit more aggressively now, and it's to meet strong demand. Okay, and it really boils down to, why is there strong demand? And I think, back to the jitters I mentioned of Silicon Valley Bank, banks are remaining capital constrained, and they've created a liquidity void. This is especially true for regional and local banks, the smallers. This might not be Bank of America or Chase or Wells Fargo, the behemoths in the banking industry, but you and we may be here in California would be shocked at how many local and regional banks there are around the country that support a lot of those local real estate entrepreneurs. And them, a lot of times with a lot of commercial real estate on their books, potentially a lot of office and a lot of other assets that have shorter maturities that are coming to maturity now in a much higher interest rate environment, that are working on a lot of loan modifications and other things. I mean, this is all over the news. This isn't just me telling you this. Okay, so these banks have to hold on to this capital, and in a lot of cases, they're just not lending. And so again, that's created this liquidity void for those local investors who are doing a lot of these deals, and they need a resource. They need capital, right? People are always going to do real estate deals. It's been going on for years. And we're seeing this every single day. Me and my team, we're constantly on the phone with folks all around the country, and we just have no shortage of favorable investment opportunities from our vast network of borrower clients. That said, we're all adjusting to these higher interest rates. I know I am, and our clients are. Do you agree, Tyler?
Yeah, we're trying to.
Yeah. I just don't see them going away. And in fact, I think like a 6 to 7% 30-year fixed is probably more healthy. I think we were a little, over the top down at that, high 2s, low 3s. And so I think that this 6 to 7% we're going to find is a normal place to be, and one that we might be for the foreseeable future. I firmly believe that. And as far as the higher rates go, that is primarily good for us as private capital providers, because we can bottom line, the longer they stay higher, the less supply there's going to be for these real estate entrepreneurs all over the country. And we can start charging more, not only on the fee side, the upfront origination fees, but in terms of the interest rates. It just becomes more normal. So with all that said, we can capitalize on this high demand, this high rate environment, but we need to increase capital to meet that demand. I'm going to show some data from Q1 that translates into how this is going to raise yield for us, which trickles down to, of course, you primarily as the capital providers, the equity backing this debt fund. So in Q1, we received payoff on 44 loans for this $11+ million, right? So we got back $11.5 million. The weighted average loan term, right, over 12 months here, and the weighted average on the rate right here in the 9 level, okay? Compare that to us then pushing money out in the same quarter, right? So we're taking capital that we received back in, plus capital that we're getting, capital we're raising from folks like yourself. We're pushed out 19.6 million. We did so here in a shorter average weighted loan term and a higher average rate at 10.43. Okay, this is extremely important. The shorter the term allows us to recycle the capital and earn another fee every time we redeploy capital into a new loan. That helps drive yield. And in essence here, we took back capital earning 9.87 and pushed it back out at 10.43%. This dynamic, due to high demand left from the void of local banks and the higher rates, are driving the yield for us. And we need to capitalize on that. Again, I don't think this is something that's going away. It's here for the foreseeable future, and it's going to benefit us tremendously without, of course, hurting that real estate entrepreneur. So bottom line here, if you're considering an increase in your position, you already have one, or if you're brand new and you're thinking about, hey, this might be a good investment for me, we strongly encourage it. Now is the time. The second thing I wanted to dive into, and what's new here, what I just discussed there on demand and increased yield and so on, is that this just couldn't have come at a better time. We've been toying with this idea for some time. The bottom line is that we are introducing preferred profit splits to our capital partners. And this has already become effective. It's applicable to those that are already existing capital partners. It applies to those who are going to become capital partners here in the near future. It's just going to be the new thing, the new norm. And the bottom line is that previously, all capital partners, regardless of capital account, meaning like, investment amount, were receiving a 50% share of the profit split after your preferred return. Okay, and based on Q1, that's not changing for those stay with a capital account under 500,000. And so based on Q1, which we had a fantastic number, you're annualizing your return based on this first quarter at 8.2%. Now, for those who are going to come in or increase their position to get to tier 1, which will take effect at capital accounts of 500,000 or greater, we are going to give you from management's cut a 10% increase and give you now a profit split of 60% compared to the standard 50%. This by no means hurts those with a lower capital account, because this increase is coming straight from management's portion. We just find value in higher capital accounts. And so with that in mind, for those with higher capital accounts, we are willing to take less profit for our involvement in running, operating, and arranging all of this on behalf of the fund. Based on Q1, those here at that 500,000 or better will start earning an annualized 8.64, which is almost a half point increase. Taking that one step further, our second tier is 3 million. So capital accounts of $3 million or greater, we're going to increase from 50 to 70%, which is that 20% increase. Of course, management then will take the other 30% as opposed to the otherwise normal since inception 50% split. This is pushing folks into north of 9%. And based on what I see in this high demand, high rate environment, I expect those accounts to push up to 10% over the next handful of quarters. So this is really cool, and I'm really happy to present this, something again that's been in the works for quite some time, and we're willing to reward those folks with the higher capital accounts.
Awesome, Pat. Thank you so much for diving into that. All right, let's go over some fund basics here as we continue to dive in to our offering to our investors here this evening. So like we had mentioned before, the minimum investment is $25,000. That's really nice. Kind of going back to the CD options, right? I was just at the bank not long ago exploring these myself. And while I was finding, shorter terms, I was often finding lower yields. And if I wanted a shorter term and a higher yield, my minimum investments, were quadruple this or more. So it's nice that minimum investment is $25,000. And it, like we had mentioned before, it is only a 12-month hold. After that 12 months, that capital is now liquid for the investor. The earnings are distributed quarterly. And you can either have these automatically reinvested like I do. That's the path that I choose because I like just sitting back and knowing that the capital is going to work, or you can take it in cash. So everyone has different goals with their investments, different things they're trying to accomplish. And this can really be used as a passive income generation tool, should that make more sense to you.
As does Daigler, I reinvest 100% of my position as well. But I think it's important to understand that you can also fractionalize that, right? We can accommodate, say, a 50% reinvestment and a 50% take of the cash, right? Because the next point here is that, regardless of whether you don't take it, the earnings are still taxable. And the only way to avoid or to defer tax is if you're investing with a self-directed retirement account. And of course, the answer to that is yes. we can take investments from self-directed retirement accounts. We have approximately 65 of those positions today compared to our approximate 300 total capital partner positions. I might also add that you can contribute more anytime you want. And so the 25,000 minimum, I think, is really cool, as it allows you to dip your toe and get invested, and then build your account, your exposure to this asset over time. And it doesn't have to be in increments of 25,000. I have a lot of people that, take advantage of this subsequent minimum. And a good example of that is people get on like a drip campaign, and they maybe come in with 25 or 50 or 100, whatever they're comfortable with. And then they set up an automatic recurring deposit of, say, $1,000 a month, or $1,000 a quarter, or $5,000 a quarter, whatever you want to do. All of that's customizable. Before we move on here, you can also redeem partial or in full. Of course, you're subject to your 12-month minimum, but after your 12-month minimum, just a reminder that you don't sign up for another 12 months, right? It just becomes what I like to refer to as a month-to-month lease, right? So at month 15, if you want to take capital out, go ahead, right? You're welcome to do so. We just ask that you give us as much time as possible. 90 days is what is the ask. But we're currently returning it based on our liquidity policy much quicker than that, oftentimes within 30 to 45 days of redemption request. Did you want to add anything to that, Tyler?
No, that's perfect, Pat. Thank you.
As far as the continued basics here, we are a partnership, a California partnership today, so you will receive a K-1, that's the tax documentation. We are toying with the idea of converting to a REIT structure. We qualify for that now, but there's some change in the government that's coming, most likely, and so we need to kind of see what that's going to look like over the next couple of months before we make any decisions, because there's certainly a large capital outlay in making that transition, but that could be a huge benefit to our capital partners in terms of tax deduction. But not regardless, I definitely recommend that you speak with a tax professional, right? If you have a CPA or an EA or something along those lines, just ask them, and if you'd like, when you're having that discussion, I'm happy to send you a copy of my personal K-1 for the investment here so that you can provide that to your CPA and they can kind of look at the nature of the income. Moving along with the investments self-directed, we talked about that. There is no unrelated business taxable income. That's very key. And one of the main reasons for that is there is no leverage on this fund. Another big benefit to what we do, we are completely unlevered, right? That just offers extreme low risk to our capital partners, right? We expect to stay unlevered in this fund. When it comes to investing with a self-directed retirement account, this is key, is the option to reinvest those earnings. Otherwise, what do you do with them, right? You just take them to your custodial account where they're too small to be reinvested into something else. So I find that self-directed retirement accounts are really, this is a great investment, one that's liquid, the one that allows you to earn on your quarterly earnings. But don't forget to round it out, you do need to be an accredited investor, which again is not a big deal. Kind of continuing on, we're a debt fund, we talked about that. So every time we make a loan, we earn loan fees and we earn interest paid monthly. The loan fees are earned upfront at origination. Our target on the loan fee is 2%. Sometimes we're able to charge a little less, sometimes we're able to charge a little more. And then on the interest rate, our target is to 10 to 12% per annum. Those sound like high rates, but in the private capital space, they're really not. They're more middle of the road. There are certainly folks out there that are charging more than that, but those folks are attracting the lower quality talent, the less sophisticated weekend warrior, not the real estate professional. So while we could charge more, we want to stay very competitive in order to attract the best of the best borrowers that keep us really out of trouble. Our target net to investor return, we mentioned it's 8%. We are beating that. Our since inception average annual return, 8.5%. We'll go over that a little bit more. In order to get to that 8% target, we need to earn a 12.5% gross return on the capital. So that's before expenses. And of course, we earn that from collecting those loan fees and interest. That's the only income that this fund earns. loan fees and interest, because all we do is lend money. All right. And so our target there of that 12 to 14 comfortably allows us to get to that 12.5. We're seeing that rise. Like you'll see in this quarter one, we were in the 13% gross on the capital stack, which is why we're seeing that increase in the yield to the capital partner. As I mentioned, the net to investor return has two elements. There's the preferred return. That is the amount that we must pay the capital partners first before we, as the managing entity or the GP, partake in any profit share element. The second element after the preferred return to the investor is that profit share, which we went over is either going to be 50, 60, or 70% of the remaining profit. Marshall Reddick is the manager. We earn a management fee to operate the affairs of the fund and to be good stewards of the capital. That covers all of the staff costs like myself and all the associated operational expenses. It's certainly not a profit share or a profit element, right? What we're after and how we make money in this fund is that profit share element, which again, depending on your capital account, will either be 50, 40, or 30%. And again, that's only after we've exceeded the annual hurdle to you of 6% of your capital account. All right, moving on here. As of April 1, so the turn of the quarter, we had 53.5 total investor capital, and we've got our returns here since inception, 1 year and 3 year. I will focus most here just briefly is that we have been operational for 17 quarters. Quarter 2 of 2024 is our 18th operational quarter, and we've hit a profitable quarterly distribution every time. That's how we built this. That is going to continue. We are just too diversified not to be in a position where we could not have a profit distribution to make. They certainly vary, but they vary within a very tight window. We've never been lower than a 1.96% quarterly distribution, and we've never been higher than a 2.33% quarterly distribution. Of course, you've got to annualize those quarterly numbers, and of course, that's where you come into our 8.57 since inception average annual return.
Thank you, Pat. Appreciate that. I would encourage everyone here tonight with any questions, anyone who wants to find out any additional information, to please contact me. That's what I am here for, is to act as an advisor and liaison for you guys. But in the meantime, marshallreddick.com/MRMF for Marshall Reddick Mortgage Fund is a great place to start your due diligence and really get into the nitty-gritty details of the fund. And so we would invite everyone on this call tonight to please feel free to utilize all the transparent resources available about the funds on this page.
Yeah, I mean, the bottom line is that we show you in real time all of the portfolio holdings. We break them down by state. Here is an example, a screen clip I took from that website today. This represents as of like, you know, again, it's changing every second, but the number that you see for each state is the number of loans that the fund holds in those states. Right, and we're very strategic about the states that we choose. And then ultimately, I love to tout our ultra low aggregate loan to value. So the you know, the bottom line here is that we are in an ultra safe position regardless of any type of market event that could happen, which just goes to show the safety and the diversity offered by this fund. Okay, as Tyler mentioned, guys, pipe, if you're going to listen in, this is what you want to listen to. We're going to get into some of these details here on the profit and the waterfall. So what is the waterfall? This is how investment returns are allocated among participants in a pooled investment. And that's what Marshall Reddick Mortgage Fund is. It is a pooled investment. We distribute 100% of total net income each quarter. We just flush it out. We start back at ground zero, and then we do it again quarter after quarter. The allocation to get there is going to be some allocation of loan loss reserve, right? There's going to be the preferred return, 1.5 a quarter, which is the 6 in annum, and then of course your corresponding profit split. So that is our waterfall. Pretty simple. And then before I dive into the P&L for the first quarter, I just want to point out to those who are not capital partners that we publish our quarterly investor letter that I release to all of the capital partners, as well as the corresponding financial statements, profit, loss, and balance sheet. These are available for the public on that due diligence website that Tyler just mentioned. Otherwise, if you are a capital partner, of course, you know, last Friday, I released our earnings distribution that had all of that information included. But we do keep that published on the website just so that those that are doing their due diligence and considering an investment have it available as well. Okay, here is the profit and loss statement for the first quarter. All right, and I'm going to walk us through the waterfall because some folks aren't quite sure exactly how this works. And so when I do that, here we go. We're going to just point right to the bottom here. $1,307,000 is total net income. That's after expenses, including the management fee. Annualize that, we're looking at 10.4% after expenses, but before profit split. Okay. Then of course we've got to jump in with our preferred return. So the 1.5% per quarter based on every investor in the fund's capital stack. I mean, I've got everybody's capital stack is different. We've got the minimums down at 25, and I've got my top investor who's got 5 million in the fund, right? So everybody's preferred return is based on your capital account times 1.5%. That represented the 805,000 number. That leaves, of course, 565,000 left to be split. That represents 1.5% of the capital stack. And then it just breaks down into, based on your capital account, are you earning 50%, 60%, or 70% of that quarterly profit to be split between you and us as the manager. So total to the capital partner is just inclusive of your preferred return and your profit split. So again, based on quarter 1 numbers, our under 500,000 capital accounts are earning an 8.2% annualized. Ours that are in that tier 2 at 500,000 or up to 3 million, you're earning the 8.64% annualized. And then of course, our heavy hitters at 3 million plus are earning north of 9%. And as I mentioned, expected to get up close to that 10% per annum number. So it's really simple when you break it down. It's actually very complicated on the back end for us to calculate this. And one of the reasons for that is that the capital is not static at the start of the quarter or the end of the quarter, right? There's new people coming in every day. There's people that have previously invested that are going out, right? Because we have a great liquidity policy. We're redeeming folks as needed, and that's important for you to know. If you want to get your money out of this fund, it's not a problem. You can't sell your position to somebody else. There's no sale market for this, and of course we're not publicly traded, so there's no exchange, but we just simply buy back your position at face value, right? And we do so rather quickly, so just keep in mind the liquid nature of this fund. And I hope that helps really kind of dive into tying the waterfall to the profit and loss statement. Breaking that down kind of individually and not from a fund level, like how would that look for you if you had a $500,000 capital account in that tier 2 preferred profit split? Bottom line here is that you would be looking at getting $7,500 per quarter on the preferred return and $3,300 profit share element. That's $10,800 per quarter earnings, which is a 2.16% quarterly dividend or distribution. Annualize that up, 30 on the preferred, 13.2 for a total of 43,200 on your $500,000 investment, which of course is the 8.64%. So I like to present it in this capacity to help folks be able to, best understand this. And of course, we're moving quickly. We've only got a certain amount of time. We are recording, and we will make this recording available to you, including the slide deck. So you can always revert back, again, if we move too quickly for you. We'll continue forward, getting close here to time. We want to run down some important metrics that are important not to lose sight of when it comes to the first quarter. And in this capacity, It's just important. How many capital partners do we have? Right. I talked about this a little bit earlier. At the turn of the quarter on April 1, 282. That number is, of course, higher now because people are constantly coming in and people are regularly leaving. 32 staff, right? So again, that more than 10% on a count number. And then, of course, the capital, right? 53.5 million total and a little bit more than 5 million from our staff. That includes, of course, my positions. That includes Tyler's positions and all of our other staff. 235 mortgage investments secured our capital in first lien position. Don't forget that. And one of my favorite metrics here, 80% of those mortgage investments are secured against single family homes. The most easily tradable, the most desirable asset purchased by the masses. And the bottom line there is that if we were to get in a problematic loan situation, it's an easily liquidatable asset in order to get the capital back and keep moving forward and avoid any potential loan losses. LTV, right? We're under 65. I just, kind of use that as the target number because we always want to remain under 65. We have for 17 straight quarters. I don't expect that to change. And so to quantify that, our 53.5 has funded 63, almost 64 million in loan principal. The reason for the difference there is we do a lot of like renovation and construction loans. So we're earning interest a lot of times on that money that's not been released based on construction progress. And then of course, the value of those 235 assets is approaching 100 million, probably over that now, considering this is as of April 1st. And so that's really how we get to that loan to value and really goes to show the safety here. And so just to use an example there, my last bullet point, our average loan amount, 271 and change, is secured by our average collateral asset value at 417. So do you feel good about investing and earning 8+%, 9 in some cases, marching towards 10 at this type of safety? I certainly do. And this is certainly something that helps me sleep extremely well at night. And that's why you're seeing us quarter after quarter writing checks to our capital partners who are absolutely enjoying the 100% passive nature of this investment. Diversification, touched on that a little bit, taking that just one step further. We're across 15 states. You saw that as a couple of slides back where I showed that map of the US and what that looks like. There's a little bit more than 15 states, but some of those don't have very many loans. So I really look at 15 primary states, and then I take that a step further with our top 3, Florida, Texas, and Indiana. The number there represents the count based on, of course, the 235 total in the portfolio, and then, of course, the corresponding percentage based on count in those states that we're in, right? So you'll find that we're in very favorable lender states, a lot of conservative states. It's also important to understand, and something that we track regularly, something we at the executive level are looking at, is that no single capital partner, no single borrower, or no single loan can represent more than 10% of the portfolio, right? That's just a good, solid metric to run by. And in fact, we'd like it to be much less than 10, and it is. It's just that 10% is sort of a hard no, so that we're not, can't be moved easily by any one event, any one borrower running into trouble, any one loan, or any one capital partner saying, I need my capital back. Our average loan amount, 271,000. I just like to show a little bit of diversity, and I find big value here compared to a lot of our competitors who, have taken institutional money, hedge fund money, insurance company money, and they're sitting on millions, billions, trillions of dollars, and they have to lend it. So those folks that are in a pressure position to have to lend is not a good position, because you start making loans that you otherwise wouldn't, because you can't sit on the capital. It creates cash drag and drags the yield down for your capital partners. So I love the fact, and that's the reason I show this here, is that our loan amounts are not high, right? They are middle of the road. And again, the number represents the count over the 235, which is how I got to the percentage. And you see right there, our sweet spot really is going to be that 250, maybe 200 up to the 500,000 is right there in that average middle class single family home all around the country. During the quarter, we had no new defaults, not that we expected that we would, but as a lending institution, periodically it's unavoidable, you do run into loan defaults, but the portfolio remains ultra strong. I expect that based at 65% loan to value with ownable, desirable underlying collateral assets. But bottom line here is we just have zero, I repeat, zero loans with payments of 90 days or more delinquent, right? Certainly some people pay late, we don't care, right? We're happy to charge them a late fee. But ultimately, folks are making their payments, they're doing what they said they're going to do, and they are paying off their loan when they need to. We took in $3.5 million in new capital during the quarter. We had 1.3 million redeemed. So folks that had eclipsed their 12 months, wasn't necessarily at the 12-month mark. They could have been in for 3 years and just said, hey, I'm doing something different, I'd like to redeem. Oftentimes I find that that's a partial redemption to go buy some other real estate asset or some other venture that they're entering into. Seldomly do we have somebody redeem their entire capital position. As far as the earnings, we talked about the 1.37. I just like to show that we've got a lot of folks reinvesting that capital and taking advantage of compounding, which of course is going to drive up that yield that we've been showing. So 650 of the 1.3 was reinvested, with 713 being withdrawn. So rounded out what happened during the quarter and just take a quick peek ahead. What's next? So we're going to continue, as I talked about in that metric, and I'm going to continue to show that. I'm going to do so probably in graph form here soon. Our focus on shorter loan terms, which allows us to turn the capital and earn loan fees faster and at a more frequent cadence. And then of course the higher rate environment allowing us to charge higher interest rates. So we're going to continue there. We're going to continue to try to increase loan fees when we can without being egregious, because we can't compromise on borrower quality and professionalism. We have to retain those quality borrowing relationships. The demand is high, we've gone over that, and we're just absolutely going to continue to see profits and continued very tight distributions hovering right around that 2%. I hope that we can get to 2.25, 2.25% more consistently. I expect that due to the environment as I've discussed. We're uniquely positioned for a couple of reasons. We've got an excellent staff. Most of the staff that works for me day to day in our private lending department has been with me for years. As I mentioned, I'm celebrating soon a 21st anniversary as an employee of Marshall Reddick. I have a number of other folks that are approaching 10 years, 5 years, and so on. So our team is excellent. We're well diversified, as I've showed you, but I think our competitive edge is that a lot of our competitors out there, they only lend money. They don't have a functioning real estate brokerage with a presence in multiple states. As you know, Marshall Reddick has many offices in Texas, in Tennessee, in Florida, as well as our home office here in California. So we're getting a lot of referral business from the biggest referral source in the world, which is, Tyler, real estate agents. Take that along with our property management business, right? So that diversity really drives deal flow to us that a lot of other folks don't have, and they can't be picky and choosy on loans that they will or won't do.
Awesome, Pat.
Tyler,
thank you so much.
Yeah,
Thank
rock
you
and roll, buddy. I want you to talk to the folks a little bit about how to get started.
Yeah, let's talk about how to get started, guys. So very first step is to have a conversation with me. All right, my contact information is going to be at the end of the seminar, but I'll also reach out to everybody afterwards. Make sure you get a copy of the seminar recording this evening. But the big first step is a consultation with me. We're going to talk about your current investments, what your portfolio looks like today, what you're trying to accomplish, and your timelines and your velocities and all that kind of stuff, so that we can come up with a strategy and a plan that would work for you. Right. Once we've decided that, next step is to get accredited, if you have not already. If you are already accredited, you can simply send that letter in to us. We're good to go. If you need to get your accreditation, we can absolutely help you guys do that. We're then going to get you access to the investment fund portal, right? So I'm going to get you guys over a subscription agreement. We're going to build you a log into the portal where you can log in, check everything out that's going on with the fund, and start making your contributions within your access. And then, yep, I skipped ahead there. I've been sending out the agreement first, but yeah, then we're going to get you guys signed up and get your investment and get your money working for you. So biggest first step is a conversation with me. And then I can help guide you through all those following steps. I also wanted to make note, earlier Pat was going over a slide on what would my investment look like. That website that we had pointed out earlier has a calculator on there where you guys can log in and you can play with it and put different numbers in of, different capital investments, different maturities that you may be focusing on, things of that nature, and it will calculate out your returns for you. So I just want you guys to know that tool is available for you.
Yeah. Yeah, and I think the rounding that out as we sort of close out here, the bottom line, folks, is that the process, the steps to get invested are very simple. It's really just more about like you becoming comfortable with what we do, because we just do one thing and we just do it extremely well, at least when it comes to this mortgage fund. So once you get comfortable with what we do and who we are as a group, and of course, if you're local here to Orange County, please come down to see Tyler and I and the rest of the team. We'd love to show you the operation. If you're not, we can do the Zoom calls and all of that. But the process, of accreditation and signing the paperwork, it's super simple, and you can contribute and transfer your funds right through the online portal, which is just like any investment that you have out there, right? You've got an account with Vanguard or with TD Ameritrade or whatever that might look like. Same kind of concept, right? You log in, you see your contributions, distributions, you download tax forms, and so on. So I think that sort of rounds it out. Tyler, have you got anything else that you'd like to share before we give the bon voyage?
Yeah, appreciate you, Pat. Thank you so much for your time. I know the clients appreciate it. I did have a couple questions come in. I know that we're at time, but if we could just hit a couple of these, I'm sure the clients would really appreciate it. So Carl asks, are the total funds invested deployed at this time, or are there any funds that are not currently working?
Yeah, that's a good question. Happy to answer that. The key to our fund keeping the yield as high as possible, and of course this isn't possible, but the ideal situation is that we have zero capital in our bank account, our fund bank account, every day. That is how we would prefer it, because that means we are earning 2 points plus 10 to 12% interest on every dollar that we're holding. Now that's logistically not possible, but we're extremely good at the different chess pieces that we have to move around every single day. When you can think about it, right? We've got to manage incoming capital from new investors. Of course, we've got to manage outgoing capital from capital partners who are redeeming. We've got to manage like loans that are in the pipeline that we've committed to fund that have different like target funding dates, which are constantly getting delayed and pushed out or moved up for whatever reason with that seller and buyer in that situation, right? And then we've got loan payoffs, loans previously originated months ago that are paying off with are being sold or refinanced. And of course, those always have a moving target, right? So it's like there's a constant ebb and flow of dollars, but we've really perfected that. But the idea, Carl, is that we don't want to have, or we want to have as little cash as possible sitting in the bank. We don't need it for like a rainy day or a slush fund. And we want to avoid cash drag or yield dilution, which will happen if we're sitting on a bunch of cash in the bank. And the reason that we don't need the slush fund or the capital lying around is because we focus on ultra short loan terms. Our loan terms, the lion's share, we're talking 80%, are 12-month loan terms or less, which means that after doing this for years, I'm literally getting paid off on loans every single day, right? That is why we have such a good liquidity policy and why I can redeem you with no problem. And if I'm not redeeming you with incoming capital from payoffs, what am I doing? I'm pushing it right back out the door at hopefully a higher coupon or a higher interest rate to drive your yield a little bit higher.
Perfect. Thank you, Pat. Thank you so much, everyone, for taking the time out of your evening to come learn about the fund and our performance over the last quarter. Again, here's all of our contact information. Please feel free to reach out. I'm going to give everybody a call coming into next week to just make sure if you guys have any questions, I'm answering them for you. But please feel free to reach out in the meantime. Thank you guys again. And Pat, thank you so much for the time. That was super valuable. I know the clients appreciate it.
Yeah, oh, and I just appreciate being here with you. And Tyler, thanks for your time. To everybody, I hope you have a wonderful evening, and I look forward to talking with you soon.
Thanks, guys. Have a good
Bye-bye.
evening.